Welcome, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, the most important hour of radio every Monday on 1580 The Big Talker. Thank you for joining me this afternoon. For those of you who don't know, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets one house at a time. I want to give a quick little shout-out to two of my new clients over the weekend, Stephen Mackey and Mark Lincoln, who are tuning in today. Great to have you guys on. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted advice. That's my message, and I will be delivering it to you guys every Monday from 2 to 3 p.m. right here on 1580 The Big Talker. We got some great stuff lined up. Joining me on our panel first is Louis Cammarosano, who is the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you what happened in the markets last week, as well as letting you know what's on deck this week that will affect you and your real estate decisions. Louis, are you there? Louis, can you hear me? Well, we try to get him back on the line. We got a lot of stuff. I mean, interest rates have been going crazy back and forth for the last probably 4 to 5 days. The stock market, I mean, literally was tanking 400 points. It was 4 straight days with 400 points one way or the other, which with all this volatility out there, it really is kind of crazy when you're a potential home buyer or somebody that's looking to refinance, because you're trying to determine when the best time to lock in is. And I know that that's a big concern for a lot of you out there. You see that the stock market is losing 400 points, and then the next day it's gaining 400 points back. The best advice that I can tell you is you really just have to make a decision based upon that day. I have a service that I subscribe to that tracks mortgage-backed securities, and a lot of the time it's a lot for the general consumer to stay up, stay in a loop about. But I highly recommend that you reach out to a professional that does have access, that tracks mortgage-backed securities consistently, and is able to kind of tell where the market is headed and the general directions that the market's headed. We've literally have record low rates, and the last 50 years there hasn't been really a better time to buy than now. Bankrate as of last week was quoting 30-year fixed mortgages at 4.33% on a 30-year fixed, and the previous week before that was 4.37 on a 15-year fixed, 3.49% last week. And the week before it was 3.52, so that moved down slightly. And the 5/1 ARM actually fell into the 2% range at 2.93% average versus the week before, which was 2.87%. So, these rates are moving down. They've been continuing to move down. And so it's a great time to really take advantage and lock in. We just don't know how long these rates are going to be there. So, for any of you out there that are on the fence, potentially looking to, stop renting and moving into an actual home that you can call your own and have a mortgage payment similar to probably, or if not cheaper than what you're currently paying, I would highly suggest, setting up an appointment with either myself or another mortgage professional that can help you know what your options are. Being armed with all the knowledge is the best thing that I can tell you, especially in this volatile market. Your biggest component of buying a home is the cost of home ownership. That's not just what you're buying the house for. It's okay. You see a sales price for $300,000. It's not just about looking at that. It's about what is that going to cost you over the long term. A lot of the times, people get so caught up in just looking at the sales price, and really the monthly payment is really where you need to consider, whether you want to buy a house or rent, because that's going to be your monthly nut that you have to carry. Right now in the Washington, D.C. metro area, we found that it is, it's incredibly, most of the times cheaper to buy and own your own home versus renting. 877-245-2030. That's 877-245-2030 is the phone number. I think we got Louis back on the line. Louis, are you there?
I'm here, Ryan.
Hey, Louis. How you doing? How was your weekend, bud?
It was great. And yours? It
was well. I can't complain. Just another relaxing weekend. We had a lot of stuff to digest in the markets. I know you sent me an article earlier this morning. I just got to glaze over it for a couple seconds, but it looked like it was showing all the treasuries that were bought at the last treasury auction, and it was one of the largest non-central bank sales last month of US Treasuries in the history.
Yep.
which is pretty incredible. I mean, and I guess the big question is, everybody's like, well, what does that mean to, to mortgage rates? And we have to, in order to keep mortgage interest rates low, people have to continue buying these U.S. Treasuries at a record pace. Would you not agree?
Yeah, they have to create the demand for them. And I think I caught what you were saying earlier about record low interest rates being good for the housing market, and I agree with that. And what you're seeing is the Fed, in a concerted effort to continue buying, to put downward pressure on interest rates, and then also coordinating with the other sovereigns to purchase U.S. Treasuries. It's interesting, they're financing their debt purchases with debt, and then the Fed is printing the money out of thin air. So how is this? Because you can't solve a structural problem in the economy.
Hey, Lewis, would you are you on your landline? Would you mind switching over to the landline, please?
I'm on the landline.
Okay, I think you picked it up now. It was just on the speaker, I think, right?
Oh, I was on the speaker.
Yeah, no worries. No worries.
Okay. What I was saying is that it'll all end badly eventually because they're temporarily and artificially keeping the interest rates low. And if you're a potential mortgage purchaser, now is the time to take advantage of the situation, because it can't go on indefinitely.
Yeah, and further into that article I was reading, too, it looks like China was continuing to buy the treasuries, where it looks like Russia's actually backing out and not buying as much. They're, repositioning and probably buying more gold and getting out of our debt.
Right. Well, China has to continue to buy them because most of their wealth is based, and not most of it, a good portion of it is based in U.S. Treasuries. And for them to get paid back, perversely, they have to continue buying U.S. Treasuries so that they can get the interest payment back from the United States.
Yeah. Yeah, it was.
Their position is so large that they're kind of forced to do it, whereas Russia's position isn't as large, and they can start to back out of the U.S. Treasury market, and as the article points out, to start to put their money into hard assets. Now, China is doing the same thing. It's just that they're continuing up their purchase of U.S. Treasuries, but they're also purchasing hard assets as well.
Right, and it's like, I guess they've got so much vested into the United States at this point. I guess it's got to be a little bit slower than other countries might, start to pull out a little bit quicker. Just because, obviously they don't want to throw any red flags. Well, not that we're ever going to default, because you sent me a YouTube video with Alan Greenspan last week that showed that he was on Meet the Press, and Greenspan basically had said that the U.S. will never ever default on its debt. And
the reason being, he said, because the U.S. can always print up the difference.
Yep.
Now, some people might look at him and say, well, he's starting to get senile. That's not true. I mean, that's something Bernanke has said as well. It has nothing to do with the age of Alan Greenspan. It just has to do with the fact that he's no longer the Fed chairman, and he can probably speak more bluntly. But that's a fact that everybody knows, that the U.S. will pay its debts if it just has to print up the money. The problem with that is the money they print up becomes worth less.
Yeah. Yep, and we've been speaking about that.
So that's default by inflation rather than default by non-payment.
Right. Yeah, when the paper's not worth anything, and 5-10 years down the road when we're starting to talk about why milk is $5 a gallon, it's going to be a completely different story. And I think it is interesting because, I made the comment that it's easier for a former Fed chairman to talk about what's going on versus Bernanke, who's in there. He doesn't want to come right out and say that that's what they're going to do, but obviously we know that that's been the trend.
But bring that back to housing prices. If you buy a house right now and it seems to be a bit expensive, but you're getting a low interest rate and inflation kicks in, you'll pay that mortgage back in the current dollars.
Right. Yep.
And that'll be a real benefit because you're paying at a low interest rate, and the value of the dollar will be lower when you pay it back in the future.
Yeah, you're right. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. Louis, I've had a lot of emails lately from people, trying to predict rates and where they're headed. And obviously, nobody really has the crystal ball that can say, okay, this is where they're going to be next week. This is where we're going to be there in a month or a year, 5 years down the line. There was an interesting blog. It was on Dan Green's the one that wrote it on the Mortgage Reports. And what he was kind of relating this back to, I believe it was Aristotle and one of the philosophies that he had on syllogisms. And thousands of years ago, Aristotle created the syllogism, and today it remains the core of the Western logical thought. And he made it go like this, where a simple syllogism goes like this. Mortgage bond markets are unpredictable. Number 2, mortgage bond markets are the basis for mortgage rates. Number 3, therefore, mortgage rates are unpredictable.
Mm-hmm.
And, that rings so true because we don't know where they're going to go. Nobody does. And the only thing that's a little bit different right now is we've had so much government intervention and kind of them stepping in and really artificially manipulating what's going on with the market, because if we didn't have the Fed in there purchasing trillions of dollars in mortgage-backed securities, rates would probably be at 7 or 8% right now.
And also if you didn't have the foreign sovereigns purchasing U.S. Treasuries as well.
Absolutely. And, and the reason why the big thing for you guys out there, they're trying to understand, okay, why are rates falling right now, is because when the market's very volatile, obviously last week we had the stock market 4 straight days in a row. It was up or down 400 points, which was, I think, the most volatile it's ever been. And when people feel like their assets are at risk, they're gonna want to pull out of riskier, asset classes, which would be stocks, and put them into a safe haven, or what's considered to be a safe haven of bonds. When they do that, bond yields shoot through the roof, and mortgage interest rates would go down.
That's a perfect analysis. However, the reason there's volatility is because people are concerned about the U.S. dollar and U.S. Treasuries, and yet their solution is to buy U.S. Treasuries.
I know, and it's how ironic is that? When you really stop and think about it, I mean, I would be putting my money in gold.
Gold or silver.
Gold or silver, one of the two. I wouldn't be throwing it back into our debt, which we know we're just going to continue to print and devalue. I mean, I think I don't know what yield it was. Maybe it was on the 2-year or something like that. The yield it was paying on that bond was like 0.53%.
You're not getting anything. You're getting less than the rate of inflation.
Yeah, it was.
In fact, I read certain banks are charging you for deposits over a certain amount just to hold your money.
Yeah, interesting to note, my brother works at SunTrust, and interesting thing that he just brought up to me the other day was like, yeah, you wouldn't believe they're instituting where if you use your debit card one time a month, they're going to actually hit you with a fee for that. So the cost of doing business and the Dodd-Frank and all these other bills that have come through are actually really going to trickle down to the consumer. We're going to end up paying a lot more for basic checking and savings accounts. It's not going to be through the form of loans where most people are, because they cut back on overdraft limits and stuff like that, the amount that banks can charge, which I believe was something like 50% of most banks' profit. That's not going to be there anymore. But,
right.
Basic check and debit card fees, I mean, we haven't had those in years, and all of a sudden that's going to be probably a mainstay throughout the banking industry. Wouldn't you agree?
I agree 100%. And the other thing that's happening with interest rates, we know we can't predict the direction in which they're going. However, we know that the downside is between 4% and 0?
Yes.
And the upside could be 4% and name your number. It could be 12%. It could be 20%.
16, 20%. Yeah.
Exactly. We've seen those before. We've
Yep.
never seen banks give away money at 0%, at least not to consumers. They give it away to the other banks, but they will never give a consumer a 0% loan.
Yeah,
buy a home.
You're right. And the interesting thing is, I think that the Fed knows, for you guys out there, inflation is the arch enemy of bonds, and it's the arch enemy of mortgage interest rates. The Fed has done two things in their recent statement where they basically said that they expect slow growth for the next few quarters, but they're also unconcerned with inflation. That is key language. We know, Lewis, that what they're doing is going to be very inflationary, 2, 3, 5 years down the road. Could be sooner than that.
It's already inflationary in terms of the money supply. You're seeing it in commodity prices. You're not seeing it in all the cost of finished goods yet.
Exactly. And with them coming in with that statement behind there that they're still not concerned with inflation, that is to really tame and keep these interest rates low. That's my opinion. They know by throwing that in there, it's making a lot of the bondholders more easy about this whole situation, I feel.
You're absolutely right, and it also gives them cover if they want to do more QE3 and QE4 and so on. They can claim there's no inflation, and therefore, because things are not going as they had expected, they can go ahead and print up more money.
Yeah, and Greenspan said last week that he planned on keeping the Fed funds rate near 0% for at least another 2 years. So, Bernanke, rather, sorry. So I would say that, that it's going to be true that we probably are going to see QE3 and QE4.
Well, you're already seeing it because they're reinvesting all the QE1 and QE2 money back into the treasuries as well.
Yeah, I mean it's been crazy. I like I said, I keep thinking that interest rates are not going to have to spike at some point, but the question is when. And when we come back after the break, we're going to jump into some quick tips to see if refinancing is the right decision for you when we come back.